Hey there, you're listening to Risk Required, the series and book all about the inside track to finance, the tips and tricks that could allow you to find financial freedom and retire from the 9 to 5, just like Ed Pitt Ford did, aged just 32. I'm Gareth Barlow, and joining me is Ed, the man with the financial Midas touch, an investor, entrepreneur, and now author. The information and opinions in this podcast are provided for informational and educational purposes only and do not constitute financial advice. The presenter, production and publisher are not responsible or liable for any analysis made by the audience based on the information in this recording. No parties warrant or guarantee the accuracy or completeness of any information. Audiences should always do their own research or consult an independent financial advisor who will advise based on the individual's specific circumstances. Ed Pitt Ford, we've talked about you as an individual. We have talked about debt. It's time to talk about investing, surely.
The fun part.
The fun part. Is it fun?
Yes. Yeah.
Why?
I was very happy to leave my job behind and go full time on investing. When you do the small company investing, we'll talk about all the different types, but you get to sit down with CEOs of young companies and they have energy and enthusiasm and optimism, and you start to believe that the world is a wonderful place, and you get to work with these people all day. And times aren't always great, but it's so interesting. You learn about completely different industries and different businesses and a whole load of stuff I never knew. So I'm learning all the time, and I'm working with great people. So yeah, a lovely privileged place to be.
This is a question I probably should have asked in either episode 1 or 2. Job title. Do you describe yourself as an investor? Is that who you are, what you are?
Yeah, so my LinkedIn says private investor, which does attract a lot of spam. But yeah, it's really hard. That's a question that I dread at parties is what do you do?
Well, according to the introduction, chill, because you retired at 32.
Yeah, and as we covered in the first episode, I'm not good at chilling and doing nothing. It's hard to describe. I normally say I'm an angel investor and starting my life in politics.
I think that's important just to differentiate. People have heard a private investor, angel investor. What does it mean? What are they?
So angel investor, I guess, describes the point at which I'll get involved in a company. So I do investments in standard Apple, Amazon, and that is not angel investing. That's just me effectively parking my money in some shares. But angel investing is where you come into a business when it's very, very young. At the point at which they wouldn't be able to get money from a venture capital firm or private equity firm, or they wouldn't be able to list or anything. They're just too small. People generally start out with getting money from friends or family, and then they go to business angels, who are people that put in anywhere from, probably $3,000 is very much the lowest end of the spectrum, like I did with the trucking company, probably up to about £50,000 as a starting investment. So that kind of smaller end of the scale. Those people will help get a company started, but that is where you see the super high growth and the big returns.
Just talk to us about your investing career, because you could say that you invested your time into the cream teas in Dorset when you were 11. You invested a bit of personality in going and finding the signs that were thrown out by the neighbour. You've also invested a lot of money in a lot of things over the course of time. Give us a bit of an overview as you as an investor.
Yeah, I mean, one line, there's always bits of your past that stick in your head, but one line that stuck in my head was someone saying, don't let £50,000 a year get in the way of £50,000 a week. Investing your time is something you've got to be really careful with, because you only have a certain amount of it. And when you're working for a business, it's very hard to concentrate on anything else. They work you hard, you're knackered at the end of the day. By the weekend, you want to go and have a blowout party, and then you start the week again, and you don't really have time to concentrate on other stuff. I think sometimes it is really important to step back and look at where you are investing that time. People will see me as the high risk end of investments, and some of them really are quite high risk. But as I've talked about before, we need to differentiate risk and return. High risk does not mean necessarily high return, and high return does not necessarily mean high risk. So I'm quite an opportunist, to be honest. I'll do those investments in businesses, but also, I might notice that the pound's looking weak against the dollar, and I'll do a quick trade on that. Those kind of things, they are super high risk, but the returns are very, very rewarding. The one I did recently, 40% in 3 days, and then if you scale that up over a year, you'd be talking a hell of a lot. But I take a lot of opportunities. You could almost argue I'm too passive in that respect. So I wait for people to come to me with investment opportunities. I very rarely go and seek them out, but I'm kind of getting very much a feel for what I think is good and what is bad. And when I'm looking at an investment, there's 4 key things I'm looking for. Desirability. Will the customer want it? Does the world want it? Scalability. So I wouldn't invest in something unless the market is at least £1 billion a year in size. Profitability. So on a micro level, does it make a profit? Does the underlying business case make a profit? And then finally, an unfair advantage. Some reason that this team, this business is going to do well in the world compared to everyone else. So a lot of the time that's because the founder has a lot of experience in that industry. They know people, they have connections. It might be because you've patented a bit of technology and only you can use it. But I need an edge for that business. Otherwise, the odds are just too slim for that company to do well.
That's you. That's your perspective. That's your position. That's what you were happy doing or not doing, depending on the circumstances. The book is written and is out there for everybody else. It's based on your experiences and your views. I want to kind of put to you a hypothetical situation. I am working a typical 9 to 5. I'm on PAYE. I've got, I'm in a relatively secure place in life. I'm not earning millions of pounds, thousands and thousands of pounds, but, I'm doing fine. And I've maybe put aside 1, 2, 3, 4, 5 grand. I've got a little bit of savings. Who am I as an investor? Who can I be as an investor? Am I an investor?
So you should be an investor, is what I would say. That's the kind of region where people put that in their savings account and they're losing money, and they're definitely losing money.
Why?
Because versus inflation, they're going to be getting less than inflation. So inflation at the moment is around 4-5%, and your savings account, they're probably around 4%. I haven't looked recently, but they're below inflation. So you're definitely going to be losing 1% a year. And it was even worse last year, where inflation was at 10% and savings at 4%. So the people are losing 6% a year of their money if they had it in a savings account. So yes, it's safe and risk-free, but you are certain to lose money, which is not where I would want to be. So your options when you've got kind of 1 to 5,000, they're less than someone who's got more, because there's always minimum investments levels, and the best investments are generally safe for people with more money. It's unfair, but that's the way the world is. When you're talking 10 quid, 20 quid investments, that's where you would go to apps like Free Trade, where you can buy a partial share, you can buy a little bit and just get used to investing and kind of get a feel for it. But once you've got £1,000, then you can start to look at things like venture capital trusts, which sound complicated and scary, but they're really, really good.
And very established.
Yeah, very established. And they spread your money across a lot of different companies, reducing the risk. So say you put £1,000 into a venture capital trust, you can then claim off the government £300 in your next tax return as a thank you for having invested in small businesses which help the growth of this country.
And this is a UK specific,
yeah. And there are equivalents of these in other countries. I don't know them all. But so you're looking at £1,000. The government's giving you 300. Some of the ones I've invested generally target around a 5% per year dividend, but that's tax free. So that's equivalent of about 8%, which is above inflation, so that's good. And then there might also be capital growth in there as well. Like one of the ones I did made 30% in a year. It was a bumper year. It was great. Lost 20% the next year, but generally there's some capital growth, there's some dividends. They're all tax-free. Sorry, capital growth not tax-free on the venture capital trust, but they normally dividend out capital growth. You have to lock it in for 5 years. That's a catch. There's always a catch. But it's a way to get returns larger than if you keep it in a savings account, or potentially larger than just putting it on the standard stock market. Also, stocks and shares, ISA, very simple, tax-free investment in shares, and there's a certain amount you can put in each year, and that's a really good way, and much better than kind of a standard ISA where it's just in cash and earning again a few percent, probably below inflation. There's definitely a few things you can do when you don't have too much, but I would very much encourage platforms like Free Trade, there's lots of other ones, where you get to start a sense of what investing's like and try it out. You can make some mistakes. If you're only using £10 or £20, you're not going to lose a lot, but you'll just get a sense of what investing's like. And that's what my whole 15 years of this has been. It's trial and error, and hopefully I'm sharing some of that so people don't make the same mistakes.
The pandemic in particular gave people spare time, and some people, not everyone, but some people decided to try day trading. Day trading, yes or no?
For me, so I used to say no, having had some experiences which I'll chat about, but that when I mentioned that currency trade, that is effectively day trading. It's over a few days rather than within one day, but it is risky, but I knew kind of what I was doing. Day trading, people do make a lot of money off.
People also make losses, significant losses.
Yeah. I did try it a bit in the pandemic, like other people. I got one of these platforms, and it's amazing. Like, I could put money on the platform off a credit card, so money I didn't have, and then they lend you even more on top of that. So they were lending me 30 to 1 on that money. So I put in £1 from a credit card, and they'd give me another £30 against that. The interest fees on that would get charged every night. So the longer you're in there, the more it racks up. But if you buy and sell within a day, you weren't paying interest on that. But that gives you an incredible potential to lose more than you have effectively, because it's all on borrowed money. So if you lost it all, you're going to owe people money that you didn't have in the first place. So they're risky platforms. So in the pandemic, I saw the pound to drop to £1.20 against the dollar, which, having tracked it for the previous 5 years, was low. And so I was like, I've got some dollar exposure in my investments. I'll hedge those investments, and then eventually that money will come back, and it will kind of effectively, I'll be locking in this lower rate for when I have to bring the money back. And that all seemed fine. It was in there. Half an hour later, it kind of roughly the same, if not a bit up. But then I went for a walk, and I started to get alerts on my phone saying I needed margin calls, etc., because the price just was continuing to drop. The value of the pound. Eventually it got down to 115, where I'd set stop losses. Stop losses are where it auto sells your position, just so you
to minimise your loss.
Yeah, so you can't lose more than you have put in on the platform,
or that you find is acceptable.
Yeah, where you're comfortable. So it dipped to my stop losses, sold everything, and then the price shot back up. So if I hadn't had them, I'd have been fine. It would come back to zero, and then it actually continued to go up, and I'd have made quite a few £1,000s for not doing very much. But instead I just lost £5,000 in a matter of hours, which was quite sickening. And I thought I knew what I was doing, and it takes you on a bit of a mental journey of do I actually know what I'm doing? I've just quit my job here, and but it was a freak event. The pandemic was completely unknown markets. You can argue to try and play the markets at that time was very dangerous. So to earn that money back, it was almost like a gambler mentality. I put more onto the platform, and eventually got myself to a position where I would kind of effectively borrow to the cost of a flat in London on this platform, and the stress was intense. And my friends could start to see it. I screwed up the start of a relationship because I was just constantly worried about this position. And eventually it came back, and it came good, and I got my money out plus the tiniest bit, and I was safe again and level. But they're stressful platforms, and you've kind of got to know what you're doing. So I'd never advise anyone to do them. I do dip into them when I feel reasonably confident, but it's not something I have mastered yet.
The book is called RiskRequired, and we obviously talked about risk when it came to debt, because it is inherently risky, but so is investing. What do you consider, what should people consider to be risky, and also what is an acceptable level of risk?
Oh, that's very tough to define.
I guess it's down to the individual.
Yeah, I think one thing to kind of try and get your head around is that you're trying to an acceptable level of risk for the return. And it's just trying to balance in your mind what those risks are against the return. And it's all uncertain. It's all a judgment call in your head. And that's why I'm saying start small, get used to it, get a feel for what's okay with you. I progressively take more and more risk as I get more and more comfortable. But I'm probably also taking less risk in a sense because I have a better understanding of what is and isn't risky. But it's really hard for me to sit here and say that's risky, that's not risky, because there's just too many variables and too many factors. But if you're not playing, you're not going to win at all. So it's getting used to playing the game and having your money in the market. Time in the market is something that people talk about. So I won't leave money in a current account or a savings account. So if I need it in 6 months or something, I'll put it in shares just so it's in the market, and therefore inflation is eating into it less.
You're not the only investor in the market, far from it. There are hundreds of millions, if not more, people who invest to some degree or another in a myriad of ways. What should people do? Should they follow the trend? Should they follow the crowd? Should they follow the advice they get from their friends? Should they follow the advice they see in maybe one of the publications? Or should they follow their gut? Because there are super savvy investors, the Warren Buffetts of the world, and there are people that make terrible investing choices and lose lots of money. If someone's looking and going, I've got a bit, I've got a lot, I've got that 10 or 20 pounds that you referenced that they could use and buy part of a share, where do they go to find out what the hell to do?
Yeah, that's a challenge because there's sharks out there. And also, they'll cover this at business school that the most investment managers who pick stocks after fees, you're doing less well than the market. So you're better off just in a tracker fund if you're going to be going into equities generally. So that is not a bad place to start, just in a tracker fund. You can start to pick stocks yourself. And gut feel is not a bad thing for that, because you walk into shops every day, you can see how they're doing. You use services, you fly with airlines, you can see what's working well, what customers like on the ground, a lot better probably than someone sat in an office buying and selling on a computer. So using that knowledge is not a bad thing, and especially young people right now, kind of teenagers and early 20s. You're the ones who know what the next Instagram is, what the next TikTok is, and the people at the bank jobs, they don't. So you've actually got quite an advantage there, and see what's trending and what might be worth investing in. But that doesn't always work. There is a reason they're there, and they're looking at the fundamentals of the business and how much debt they're taking on and how much risk and so on and so on. So you can do all of that, but you're unlikely to do that better than the thousands of people looking at that stock. So in terms of your time and how much you invest in it, using your gut feel is not a bad way to go. Then when it comes to the more difficult investments, when you're investing directly into a company, they can be harder to find. But there are now platforms for them. There's Seedrs and Crowdcube where they're all pitching to you. I find that on those platforms they can be quite highly priced because they know that they're going to a less well-educated market, effectively less well-financially educated market, so they can price a little higher because they've got the information advantage there. So I find my best ones are friends, connections that have an idea, have a business, need some money. You can get all the information off them. You can kind of interview them as much as you like, have a look at all their financials. You've got a bit of an advantage there because it's quite hard for them to find investors. So you coming in with some money is actually, you've got the hand for once.
There's investing into businesses. There's investing into multinational corporations, into ideas and concepts like you did in Truck Labs in 2009, and into technology, into a patent, into a thing as well. And with regards to things, what about, investing into a massive cask of whiskey? You increasingly see those kind of adverts.
Yeah.
Is that warranted? Is that worthwhile? Is that savvy?
You're probably going to get an advert for that on your phone now. You said it out loud. Yeah, I mean, I've had people saying I should invest in wine. There's tax breaks around that as well. It's not something I understand. I'd have to research and kind of get upskill on it, and I don't know what the returns are. Yeah, there's a huge investing world out there, and I'm talking about the bits I've learned about and talking about the lessons I've learned doing that, good and bad. You can pretty much invest in whatever you like out there. Property is one I kind of am a bit negative on. I know that taking mortgages, you can lever yourself up, as in like take on debt, and you're making money on other people's money. So there's a good side to it there, but I think you're making the housing crisis worse generally. And I think there's way better returns to be made in small businesses that are going to grow, to 10 times their size than the property, which is a more steady revenue stream.
You've alluded to there, I think to a degree, latter parts of the book, and also episode 4 when it comes to kind of investing housing crisis. Maybe a bit of politics is coming into that as well, which we'll get onto in due course. Obviously, entering into an investment is the first step. There's then the step of holding on to that investment for whatever duration. And then there's that step of selling that investment, reaping the rewards, or potentially trying to stop the losses, or potentially incurring the losses. At what point do you make that decision of going, it's time to stop?
So with these small investments, you're locked in basically until either that company floats on a stock market or sells to another company or goes bust. pretty much. They're your choices. You can do an earn out and they can start paying dividends, and over time you'll get your money back, I guess, as a fourth option. But really it's out of your hands, unless you own so much that you can then start advising the CEO, we should sell now, or look to do a flotation. I almost dread the day that Octopus floats, because then I'll have to decide whether to sell that or hold it every day, because it will be floated, and it will be then down to me.
When you say float, go on open to public investors.
Which it may never do, but at some point the Octopus Energy might get put on a stock market, and then every day I can make that decision to buy or sell, and I can regret that decision if I get it wrong. And I look at Amazon and I see, if people had pulled out on day one of Amazon, they might regret that now. So there's not too much to do. Once you've made the investment, you can try and help that business. You can put them in touch with people. You can invest more. That's quite a common decision you have to make, is when they do another funding round, do you put your money in or not? And then there's decisions around, are you doing that to get further rights? Because normally the next load of investors, they get way better rights than the existing investors, and they might get paid out first in the event that it gets bought. So then it starts to get a bit more complicated. But don't think that you can't do that. You can read the legal papers just as well as anyone else. And if you don't understand something, you can ask a friend or ask a lawyer, or they're quite generic documents normally, so the answers will be available. I Google a lot of the answers when I'm reading these things. Investopedia is great for explaining what's going on. So read it yourself, and then you'll start to get a feel for what's normal and what's not normal, and you can flag stuff. If it doesn't feel right, it probably isn't right, and it's probably the incoming investor trying to get away with it. So flag it, and other people might not have realised.
And with stocks and shares, I guess you can sell whenever at the end of the day.
Yeah, that's where it gets more difficult. And I know that some people, if it's gone up 10% in a month and you're feeling good about it, the temptation to sell is quite high, because you're like, I'll lock that gain in. But again, it's back to time in the market, and I feel like the longer you're there, the more likely it is to go up. There's no reason that just because it's gone up 10% in the last month that it won't go up 10% next month, and there's no reason that if it's gone down 10% it will go down 10% the next month. And when I used to buy stocks more often, I'd pick the ones who'd had quite a big fall, hoping that there'll be a bit of a rebound. It's hard, and trying to time the market is a risky game. But there are bigger warning signs. I remember when I had my inheritance when I was younger, huge amount of money for me, and it was managed by an investment firm. The recession hit and it lost 30% of its value, and I was really angry at the people managing the funds. I was like, they're meant to be experts, and they're charging their fees regardless. And then they saw the previous year the market had gone up 30%, which is completely unsustainable, crazy. Surely that's the warning sign that there's a big drop coming, and they should get out, hold, and see where things happen, and then buy again when it's low. But they never take big bets like that, because they're paid on funds under management, and regardless of what happens, so they just take low risks. They're like, hold out for the long term, it will bounce back, all these things that you hear. But what I love is a real active investor who's like, actually, this is seeming a bit difficult now, let's sell everything, let's go into property or sell that, and to make some real big bets. And it's by making those big bets that has actually done me quite well, the remortgage and put into Octopus. So there is a bit of time in the market to do, and there are costs associated with that, and tax to pay if you've made a gain. But being a bit more bold and trusting your gut and not being scared of it actually helps quite a lot.
My final question, certainly around investing, is everybody has their story of the success story. For you, Truck Labs did very well. Octopus is potentially going to do very well, depending on that flotation, depending on how that all goes. And so many investors also have that story. If I was in the room when, and I passed up on when, do you have that moment, if only? Or have you been savvy enough, lucky enough, or just don't really care enough sometimes that you don't have that if only that had happened?
Yeah, I don't have an if only story yet.
Do you worry you ever will?
I don't know. I think I've been lucky enough. I've had a couple of big wins. I've got some that are looking really, really good at the moment. So I feel like I've had my fair share, to be honest.
Would you feel aggrieved, peeved, if you're like, if in 20 years' time someone offered you something and it turned out to be the next, Uber or whatever, would you be like, if only? Or
No, I would. I may not necessarily find out things change names. I don't go and research what I've said no to.
No, it's done. It's done.
Behind
you.
Out behind me. Like, I could, and I might get some learning from it, but I probably, if it's done really well, I'm going to be kicking myself. It's not. You've got to remember your mental health journey through all of this as well, and kind of lingering on the mistakes is not necessarily the answer. And there's a thing on Instagram that just sticks in my head where there's like a glass of water and someone puts a spoonful of mud in it, and then they're trying to spoon out the mud, and it's always still just a muddy glass of water. Like, the only way to do it, and they get a full jug of water and they pour it in and it all cleans out. So that's it. Just keep looking forward to the next investment, the next way you can make money. That's a way better use of your time than kicking yourself over the old ones.
We said in the introduction that you were a man with a degree of a financial Midas touch. You've done fairly well for yourself, it's fair to say. We said you were an investor, an entrepreneur, and an author. We also said in the first episode, we were kind of looking at you as an individual and your background, but also your present and the future, that you are on a political journey too. Sounds like that's time for episode 4.
Thanks for listening to my podcast. For everything the banks don't want you to know, you'll find the details in my book, Risk Required, out soon.